When people find out that I'm a finance professor at a party, I usually get asked lots of questions. Many people want to know if interest rates are going to rise or fall. So, should they refinance now or should they wait? Should they lock in the rate or let it float until closing? Is the bond market going to tank or will it be a safe harbor? To be honest, these conversations usually aren't very satisfying for either of us. And that's because the very nature of these questions implies that they expect me to have a crystal ball that allows me to see into the future. I don't. However, there is a bunch of information about the future contained in bond prices. But explaining how to get at that information is fairly involved and requires quite a bit of background. But for you, my students, in this lecture, we're going to take a close look at how you can get the information in those fixed income markets. Specifically, we'll examine how, at any given moment in time, interest rates vary with time to maturity. We will then examine what that tells us about how interest rates might change over time. In this lecture, we'll spend most of our time discussing expected returns. The 2 lectures after this one will explore the nature of bond risk and how to measure it. In this lecture, we'll examine the yield curve and the term structure of interest rates. First, we will define the yield curve. Second, we will then examine how you can use the yield curve to determine the present values of a series of future expected cash flows. Then third, we'll examine the information content of the yield curve. So let's start by defining what a yield curve is. So far, we've considered present and future value calculations given a single interest rate. But if you were to spend a couple of minutes searching the web for the interest rate, you would see that there are many interest rates. The rates often differ because they correspond to very different borrowing and lending activities. One example is that interest rates differ by the maturity of the bond. For example, if you invest a 1-year T-bill, you'll get a different interest rate than if you invest in a 10-year Treasury bond. A yield curve is simply a plot of the relationship between the yields to maturity and time to maturity. With any yield curve, time to maturity is across the horizontal axis, and yield to maturity is on the vertical axis. The term structure of interest rates refers to the structure or the shape of the relationships between yields and time to maturity. To see the current yield curve on U.S. Treasury securities, you can go to Bloomberg.com and click on the U.S. Treasuries link under the Rates and Bonds under the Market Data pull-down tab on the home page. A word about some nomenclature. As I've hinted, we're going to be talking about how current rates relate to future rates. There are 2 types of markets. One market is one in which people trade bonds that mature in the future for delivery now. This is referred to as the spot market. There are other markets where people trade contracts for trades in the future. These are markets for forwards or futures contracts. We will not be discussing forward and futures markets in this lecture. We will just be looking at the information about future spot market rates that can be gleaned from the rates in the current spot market. Most yields are based on the prices of zero coupon bonds. For example, the yield to maturity for the 10-year time to maturity is the yield for a bond that makes a single payment in exactly 10 years. As it turns out, there are many zero coupon bonds traded in the market for all maturities up to 30 years. And that's because there are bonds called strips, which stands for separate trading in registered interest and principal securities. These zero coupon bonds are the separate coupon payments and the face value of the principal from coupon-paying Treasury bonds. That is, the coupons and the principal payments from coupon-paying bonds have been stripped apart and are sold separately. Each payment is a zero coupon bond. You can have a yield curve that's based upon yields from non-zero coupon bonds. The zero coupon yield is cleaner since it reflects at any given time to maturity just the rate for lending or borrowing for just that length of time. The yields on a zero yield curve plot are obtained from the market prices of zero coupon bonds. specifically, for a given price per $100 in face value, the yield, let's call it Y, for a given time to maturity, say T years, is simply the rate that solves the following equation. The price equals 100 divided by 1 plus the yield to maturity raised to the T. So for example, if the price of a 10-year bond is $75 per $100 in face value, then the 10-year yield is Y such that 100 divided by 1 plus Y raised to the 10th power is equal to 75. The solution is simply Y is going to be equal to, the ratio of 100 over 75. From that, we're going to take the 1/10th root and then subtract off 1. That answer ends up being 0.029186 or 2.9186%. Note that this is an annualized effective rate. Typically, yields increase with time to maturity. That is, the typical term structure is one in which the yield curve is upward sloping. We will see why later in this lecture. Let's do two things first. First, let's consider a hypothetical yield curve to solidify our understanding. Then, given that yield curve, let's see how you would use it to discount a stream of future expected cash flows. To keep that simple, let's consider a hypothetical yield curve for zero coupon bonds that mature in 1, 2, and 3 years. Let's say that the yield on the 1-year zero is 4% or 0.04. With such a yield, for $1,000 in face value, a 1-year zero would sell for $961.54. Let's say the yield on the 2-year zero is 6% or 0.06. With that yield, the price of $1,000 in face value for the 2-year zero would be 1,000 divided by 1.06 raised to the second power, and that's equal to $890.00. Finally, let's say that the yield on the 3-year zero is 7%, implying that the price per $1,000 in face value will be $816.30. Since the 3-year yield is bigger than the 2-year yield, which is also bigger than the 1-year yield, this yield curve has the typical upward slope. Next, let's consider how you might use the yields for zero coupon bonds to price non-zero coupon bonds. Recall, by value additivity, the present value of a stream of payments, say the coupons and the face value of a coupon-paying bond, is simply the sum of the present values of each of the separate parts of that stream. So let's consider a simple bond that has a face value of $1,000 and pays an annual 5% coupon only once a year that matures in 3 years. The cash flows on this bond are going to be 5% times 1,000 or $50 at t equals 1 after 1 year, another $50 at t equals 2, and then the face value of 1,000 plus the final $50 coupon payment for a total value of $1,050 at t equals 3. To figure out the value of this coupon bond, we need to figure out the present value of each of its payments. What is the present value of the first $50 coupon payment at t equals 1 year? For this, we can use the yield curve for zeros. For that yield curve, we know that the value of $1,000 in 1 year is $961.54. Given that, what must be the value of $50 in 1 year? Well, since $50 is just 5% of $1,000, then $50 in 1 year must be exactly worth 5% of the value of $1,000 in 1 year. That is, 50 in 1 year is worth 0.05 times $961.54. That's equal to $48 and 0.077. Equivalently, 50 in a year is just 50 discounted back using the 1-year yield off the zero yield curve. That is, the present value of 50 in a year is going to be 50 divided by 1 plus the interest rate, the 1-year yield of 4%. Raise that to the 1 power because we're going to discount it back 1 year. That's equal to, in dollars, 48.077. You get the same answer. To get the present value of the whole stream of payments on the coupon-paying bond, simply discount each of the payments from that bond at the zero yields that correspond to when each payment is made. Then add up all of the individual present values. The result in this case is $949.69. Okay, now that we have seen some of the ins and outs of the yield curve, let's see why a yield curve might have a particular shape. As I said earlier, a typical term structure is an upward sloping yield curve. Why is that typical? To understand why, consider how you would feel investing in zeros with different times to maturity. If you invest in a bond with a long time to maturity, you're implicitly tying up your money for a long time. If you invest in a shorter term bond, you're implicitly tying up your money for less time. As a result, you may need to get a greater return to induce you to implicitly tie up your money for a longer period of time. Thus, the yield will increase with time to maturity. I keep qualifying my statements with the word implicitly. I say implicitly because you personally are not forced to tie up your money until maturity. You do not have to hold a 10-year bond for 10 years. Rather, you can sell it to someone else prior to maturity if you need the liquidity. But the person you sell it to will either, one, have to hold it until maturity, or will have to sell it to somebody else early who will either have to, A, hold it to maturity, or B, find someone else to sell it to who will ... until some last person who has to hold it to maturity. So even though you do not have to hold it to maturity, someone will have to. It's just like you're passing a hot potato. Just because you don't have to hold it doesn't mean it's not hot. Thus, the rate at the time that you buy is based on what people are willing to pay given that someone must hold it to maturity. Since someone is tying their money up for a longer period of time, the return per year demanded is typically higher, making the yield curve slope upward. The extra return is called a term premium. We will return to term premium at the end of the lecture. In some cases, however, the yield curves have been downward sloping. That is, the yields on longer-term treasuries are lower than those on shorter-term treasuries. To highlight that this is not typical, this is called an inverted yield curve. There was an inverted yield curve starting in August of 2006 that lasted about 10 months. At the time of the inversion, the financial press was rife with articles quoting experts claiming that such a shape was forecasting a coming recession. 7 months after the inversion period ended in January 2008, the U.S. economy was in the first stages of the so-called Great Recession that happened in the 2008 financial crisis. To see why the shape of the yield curve might tell us something about the future, let's go back to our hypothetical upward sloping yield curve and see what that might tell us. The way we're going to investigate the determinants of the shape of the yield curve is by considering a couple of alternative multi-year investment strategies. The efficacy of such strategies will depend upon what the future rates turn out to be. Thus, your willingness to adopt one of these strategies will depend upon your expectations regarding future yields. Let's say your investment horizon is 2 years. Let now be t equals 0, and let the end point of your strategy be t equals 2. Let's consider 2 ways in which you can get a return over 2 years. 1. The first way is to invest in the 1-year zero at the 1-year yield of 4%. Then when that zero matures at t equals 1, roll over the amount that you get at maturity into another 1-year investment that matures, say, at time t equals 2. Let's call this the rollover strategy. The second way is just to directly invest in the 2-year zero at its annual 6% yield. Let's call this the direct strategy. Note that for the rollover strategy, you have some uncertainty about what the 1-year rate will be next year. If you could know next year's 1-year rate for sure, what would it have to be to make you indifferent between these two strategies? The answer to that question is called the forward rate. Note that for the direct strategy, per dollar invested, you're going to get $1 times 1.06 raised to the second power. That equals $1.1236 after 2 years. If you do the rollover strategy, each dollar you invest will grow to $1 times 1.04 equals $1.04 after 1 year at t equals 1. Then if you take that amount and invest it at the 1-year rate available at t equals 1 for 1 more year, what are you going to get? At t equals 1, there may be many one-year zeros that you can invest in. For example, there may be a zero that was initially issued with a time to maturity of 10 years that at t equals 1 is now 9 years old. Thus it matures at t equals 2. There may be a new zero issue that matures exactly in 1 year at t equals 2. Since all of these zeros just make a single payment at t equals 2, the rates on all of these will be the same. The rate will be reflected on the yield curve at t equals 1. Specifically, on the t equals 1 yield curve, the rate will be that which is associated with the time to maturity of 1 year. Let's call this rate R11 for the rate on a 1-year zero at t equals 1. Let's let the first number be the date of the spot market and the second number be the time to maturity. What does this rate have to be for the rollover strategy to generate the same 2-year return as the direct strategy? That is, what is the forward rate? The answer is the solution to the following equation. We're going to have 1 plus 0.04, that's the current 1-year rate, times 1 plus R11, that's 1 plus the future 1-year rate, is going to have to be equal to 1 plus the current 2-year rate of 6%, all of that raised to the second power. Thus, the answer to this question is R11 is going to be equal to 1 plus 0.06 squared, all of that divided by 1 plus 0.04. That equals, and we're going to subtract 1 from that, that equals 0.080385. Thus, if the 1-year rate is 8.0385% next year, then the rollover strategy will generate the same 2-year return as the direct 2-year strategy. Thus, 8.0385% is the forward rate. Now, you may have the intuition that the forward rate is the value when averaged with the 1-year yield generates the 2-year rate. If so, that's good. Unfortunately, you can't really get a forward rate simply by saying that 4 and 8 averages to 6. While 8 is close, that process does not take into consideration compounding. Due to compounding, it cannot be a simple average where you just add up the values and divide by 2. Rather, due to compounding, the forward is based upon a geometric average. Although numbers are slightly different, you can still use your intuition based upon simple averages to understand what's going on. Now, to see what you might do with a forward rate, let's consider some examples. And for now, just to keep things easy, let's say that all you care about is the expected return, that you are risk neutral. We'll examine risk and risk aversion later once we see what's going on with this simpler case. Let's say you think that the yield to maturity on 1-year zeros will be 7% next year. If you want to get a good return over the next year, between now and 1 year hence, do you want to invest in the 1-year zero, or do you want to invest in the 2-year zero and sell it next year and realize the capital gain at that time? If you invest in the 1-year zero, you get the yield to maturity on that 1-year bond. That is, you get R equals 0.04. You get 4% for sure, always. What if you invest in the 2-year zero and sell it early? What do you expect to get on your investment over 1 year? Well, it depends upon what you expect the 1-year zero yield will be next year. Recall that the price per $1,000 in face value for a 2-year zero was $890 and no cents. If you think that the 1-year yield to maturity will be equal to the forward rate of 8.038% next year, then what do you expect you will be able to sell the current 2-year zero for next year when it's a 1-year zero? You must think you should be able to sell it for what? 1,000 divided by 1 plus the 1-year rate next year, which you think is going to be 8.038%. So take 1,000, divide by 1 plus 0.08038. That ends up equaling what? $925.6, $925.60. The return over that year is R, such that 890 is equal to 925.60 divided by 1 plus R. Turns out the return then, that holding period return, is going to be equal to 925.60 divided by 890 minus 1. That's equal to 4%. That is, you get exactly the same return from investing in the 2-year and selling it early as you would get by directly investing in the 1-year. Now, what if you were to expect the rate to be lower than the forward rate? For example, let's say that the 1-year yield to maturity will be 7% next year, not the 8%. If so, then you must expect that you will be able to sell the current 2-year zero for what? 1,000 divided by 1.07, which is 934.58. In 1 year, you'll be able to get that price. In that case, the 1-year return is the R, such that what? 890, the price you paid for it, is equal to what you're able to sell it for, discounted back at 1 plus that interest rate R, 934.58. So the R, the return that you get over this year, is going to be 934.58 divided by 890. Take all of that, subtract off 1, that gives you a return of 0.05 or 5%. That is, you'll get a larger return than if you were to just go out and get the 1-year zero, if it's the case that you expect short-term rates, the 1-year rate next year, to be what? Less than the forward rate in the current yield curve. And if you think the 1-year yield to maturity next year is going to be 9%, then when you expect to sell the 2-year zero next year for $9.17.43, and 2, your 1-year return from investing in the 2-year zero will be only 3.83%. I'm sorry, it'll be 3.083%. That is, it will be less than if you were to directly invest in the 1-year zero. So if you think the 1-year rate next year will be higher than the forward rate, for example, 9% versus 8.038%, then you should invest directly in the 1-year. But if you think the 1-year rate next year will be lower than the forward rate, for example, 7% being lower than the 8.038%, then you should invest in the 2-year and sell it early next year. Only if you think the 1-year rate will equal the forward rate will you be indifferent between the 1-year and the 2-year zeros. Now, by the way, what if everyone in the market is just like you, i.e. they only care about expected returns? Then what would be the forward rate? What would the forward rate have to equal? Well, let's consider some supply and demand forces. Let's say that the yields are as in this example. The 1-year yield is 4%, the 2-year yield is 6% for a forward rate of 8.038%. And let's say that everyone thinks that the 1-year rate next year is going to be 7%. Then what would everyone do? Since in this case, the return from investing in the 1-year and holding it to maturity is 4%, but the return from buying the 2-year and selling it next year is 5%, as we calculated earlier, everyone would rather buy the 2-year and sell it early. But if everyone did that, what would happen to the prices of these bonds? We have many people buying the 2-year bond, which bids up its price, and as the price rises, the yield will fall. So the 2-year rate will drop from 6% to some lower value. And then if we have everyone avoiding the 1-year zero, the price of the 1-year will fall. And as it falls, the yield on that 1-year zero will rise. It will rise from 4% to some higher value. All this buying of the 2-year and selling of the 1-year will stop when the investors are indifferent between investing in the 1-year versus the other. For example, if the 1-year rate turns out to be 4.23% and the 2-year rate turns out to be 5.606%, then the market is indifferent and they will want to hold both types of bonds. With these rates, the forward rate is calculated as 1 plus the 2-year rate, 0.05606, take 1 plus that, square it, divided by 1 plus the 1-year rate, 1 plus 0.0423, take all of that, subtract off 1, that equals 7%, which is the market's expectation of the 1-year rate for next year. That is, for a given expectation in the future, the current yields adjust until the forward rates are equal to the market's expectation of the future spot rate. This is called the expectations hypothesis, that forward rates are expectations of the future short-term rates. So, to summarize, if you don't have a view on what interest rates will be in the future, then you can use the yield curve to calculate a series of forward rates, and under the interpretation of forward rates as expected future rates that will occur in the future, you can use these as to get a sense of what the consensus view is from the market as to what those future rates will be. We have seen that in a risk-neutral world, the forward rate is the market's expectation of the future short-term rate. Under this, what does an upward sloping yield curve imply about the market's expectation of future short-term rates? Not just next year, but years beyond that. What if everyone thought that the one-year rate was going to stay at 4% every year for the next few years? In that case, the forward rate would just equal 4%. The two-year yield would be such that what? 1 plus the current two-year yield, R02, squared would have to be equal to what? 1 plus the current one-year rate of 4% times 1 plus the forward rate of 4%. Okay, that ends up equaling what? 1 plus 0.04 squared, and that should be equal to 1 plus the two-year rate squared. So it's got to be the case that the two-year zero would also have a yield of 4%. Similarly, if the market expects that the one-year yield will be 4% in 2 years, then the annualized yield on the three-year zero will also be 4%. That is, the yield curve will be completely flat. In the simple example we had before, the yield curve was upward sloping, and the forward rate for the one-year yield next year was greater than the current one-year rate. That is, the reason the two-year yield is bigger than the one-year yield is because it's the average of 4% and the higher one-year yield that we expect next year. The expectation is rising, and that expectation pulls up the two-year rate. What is the forward rate for the 1 year, 2 years from now? It's going to be the rate that solves 1 plus the two-year rate squared times 1 plus the one-year rate that we expect to occur in 2 years. All of that has to equal what? 1 plus the three-year rate raised to the third power. In the case we had with the original yield curve, the solution is 9.0284%. So it continues to slope up because the market expects short-term rates to continue to rise. Note that the increase in yields from the 1 year to the 2 year was bigger than the increase in the yields from the 2 year to the 3 year. This happens because there was a big expected jump from t equals 0 to t equals 1 in the 1 year rate, from 4% to approximately 8%. But the jump in the 1 year between t equals 1 and t equals 2 is expected to be smaller, from approximately 8% to approximately 9%. This results in the slope of that part of the yield curve increasing, but increasing at a slower rate. Recall that periodically we've had downward sloping yield curves. That is, the yield curve is inverted. What does this mean? That means that the market expects short-term rates to decline. This is typically associated with the expectation of a future recession and very slow economic growth. When the economy is in a recession, the Federal Reserve typically increases the money supply in order to lower interest rates in hopes that low rates will spur investment and greater economic activity. The Fed typically does this by keeping short-term rates low. Thus, when the yield curve becomes inverted, the market is expecting the Fed to act in this way. The inverted yield curve of 2006 did a very good job of predicting the recession and the low rates that followed. We have seen that in a risk-neutral world, forward rates are expectations of future spot rates. So why do yield curves typically slope up? Does the market always expect short-term rates to rise? And since they don't always rise and keep rising, does this mean that the market is systematically wrong? The answer is that the forward rates have an additional component when the market is risk-averse, and that additional component generates the upward slope. These additional components are called term premium. Term premium come from the fact that longer-term bonds are riskier than shorter-term bonds. that they are hotter potatoes than the shorter-term bonds. What does this imply, or why does this imply the upward slope? Well, let's consider the case in which everyone thinks the one-year yield will be 4% on average for the next 2 years. Under risk neutrality, then the 1-year and the 2-year yields will both be 4%, as we argued before. And the forward rate will again be 4%. Okay, so for reference, the price of the 2-year is per $100 in face value is going to be 92.4556. But if the 2-year bond is riskier than the 1-year bond, then risk-averse investors will be willing to pay less than that $92.4556. If the price is lower, then the 2-year yield is higher, say it rises to 4% plus 0.25%. At this 2-year yield, what is the forward rate? It has to be bigger than 4%, the expected 1-year rate next year. In fact, the forward rate in this case is equal to what? The 2-year rate, 1 plus 0.0425 squared, divided by 1 plus the 1-year rate, 1.04. All of that subtract off 1, that equals 5%. 5% is the forward rate in this case. The difference in the forward rate and the expected future spot rate next year is the term premium. In this case, it's 1%. Thus, term premium reflect the extra risk in longer-term bonds. As the term of the bond gets longer, the term premium gets bigger and bigger. As a result, even if the market expects yield curves to stay pretty much the same, yield curves will have an upward slope reflecting increasing term premium. In this lecture, we've seen how you can glean information about the future from yield curves. We've also seen that aside from the market's expectation about future interest rates, term premia make forward rates hard to interpret. For many securities in the fixed income markets, there are many people all looking at the same data. And the kind of data they're all looking at is pretty much public information. It depends upon how you read the subtle messages in what the Federal Reserve chairman says or what he doesn't say. It depends upon GNP growth and inflation. It's not like stocks and corporate debt, where knowing a lot about an individual firm may give you an advantage. Rather, with things like the U.S. Treasuries, knowing a lot puts you merely on par with a lot of other people whose job it is to spend time running the numbers. So trust what the market rates are telling you.